Hey everyone, welcome to the video. Let's talk about some positions gone a little bit wrong and turning those into winners in the end, right? So we're turning lemons into lemonade. And there's a reason that we're able to do that because we're set up properly given the environment that we're in. So I'm Hans Albrecht, former market maker, 15-year professional options market maker, and then after that managing between 9 and 12 income funds, option overlay funds to generate cash flow, generate income. So a massive amount of experience, and I'm happy to be able to bring my thoughts and insights to you guys. Thank you for watching. Please click subscribe, like, do all that stuff. Drop some comments in the chat. That always helps me, even if it's just, hey, I liked your video, or if you have a question, absolutely, or I didn't like your video, let me know why, because I always want to do things better. So today's information, of course, is for educational and information purposes. Your trade, your responsibility. This is for learning, so let's get to it. So we're going to talk a little bit about credit spreads gone wrong. We're going to turn lemons into lemonade on one of my favorite stocks, Meta. And we are going to talk a little bit about how the various elements go into the setup to make sure that we're set up for this a good amount of the time. So risk monitoring, absolutely. We're always looking at risk, because what are we doing when we do option selling? We're kind of turning assets into a kind of a bond proxy. And what is important when we turn things into a bond? Well, with an actual bond, you get your money back at the end. But with a bond proxy on Tesla or Microsoft, sorry, but Elon is not going to give you your money back if Tesla goes down. So quality, stability, all those things are very important. Not that they can't go down. Quality stocks go down, but quality stocks are going to be more resilient. Things with the metrics that we look for in our programs, the fundamentals, the cash flows, the return on invested capital, et cetera, et cetera. These are all important things. So I don't want to beat a dead horse on that one, but you'll find that that's a big part of the approach. So suitable approaches to income trades when conditions are met. We're going to look at implied volatility. We're going to listen to markets. What are the markets telling us? The market is right. I don't bet against the market. I bet for the market, and I certainly am open to the possibility of markets doing things that I do not expect. So we're going to show you how these trades go, right? We're going to use this bull put credit spread. So this is a credit spread. I'm going to explain that in a moment, how that works. That expects things to stay relatively stable, right? Things can go down, but generally you want them to stay above a certain level in order to collect that credit that you've taken in. So let's look at the trade that we did. We sold the May 545 put. This was on March, I think, 26th. I'm going to show you. Sold the May 45 put for 865, and we bought the May 535 put for 665. So how does that work? Well, let's take a look here at how a put spread works. This isn't the greatest diagram because I hate it when they do this. They kind of show the upside the same as the downside, and it's a little bit disingenuous. Generally, your upside is going to be a fair bit lower than your downside, typically kind of a 5-to-1 or 4-to-1 when you do these kinds of spreads, depending on how far away you are from the spread. But the theory is correct here, right? So the idea is that above a certain point, you have the benefit of collecting that spread. Now, this blue line is going to be your expiry line. So this is how things look at expiry on a spread that goes from 51 to 49. So it'd be selling the 51, buying the 49. And this is going to be your reality. Below 49, you take your max loss. Above 51, you get your max gain. And then in between those two strikes, you'll have different outcomes. This red line is going to be your real-time P&L, right? So if this stock starts to move as soon as I put the trade on, tomorrow, the next day, the day after, this is what my P&L is going to look more like. It's not going to follow this very angled P&L. This is only what exists if we don't touch this thing and we wait till expiry. The reality of it is that things happen, right? And in my other videos, I talk about implied volatility going up and down and having different Greeks at play and Vega risk and all that kind of stuff. Right now, let's just focus on the expiry P&L, which is really, that should be our actual focus, because when we set these up, we want to know what is our maximum loss on this spread. So if I sell a 10-point wide spread, selling the 545 put with the stock over 600, I'm buying the 535 put for some protection. So what am I doing? I'm selling a $10 spread. So my maximum risk on this is $10. Because I'm going to be taking on the risk of this put that I've sold all the way down to 535, where I have this protective put to make up for it. So my maximum risk on this is $10. However, I'm taking in $2 for having sold this spread. The person buying this spread is paying $2 for the leverage of being able to own this protective spread.
Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video.
I am saying, hey, listen, you may or may not be right, but I'm going to collect $2 for this right now. This is an income trade, right? Income trades tend to be credits, and you can see here we got $2 net credit for this particular trade, and we can take a look at it here. Okay, so let's add a couple of little arrows here to give us a nice visual on the chart of how this looks. So the stock is trading up here above $600. We had a little breakout above this nice line, so we're starting to look good again. I'm sort of thinking I'm going to show you some of my other reasoning, but we're kind of above here. We've definitely tested these lows around this 200-day moving average, and we bounced off of it, and now we've come above this nice downtrend line that actually extends. You can't see it here, but it extends all the way to the previous highs around 740. So very nice upside break on this, and we're pulling back a little bit. And I've decided, well, I'm going to take on this credit spread because I think Meta is going to basically kind of stay above certain levels. Hopefully we get a market that cooperates. So we'll see what happens, of course, because we have that nice benefit of hindsight now. So we've sold the 545 put, and we have bought the 535 put as a hedge, right? So we've sold this $10 wide spread. We have a $10 risk in this particular position. Now, the nice thing about credit spreads is you get that nice capital efficiency. So the maximum I can lose on this particular position is $1,000. I've taken in $2 for a one lot. So I've taken in $200. My maximum risk is always going to be the spread between these two strike prices, 545 to 535. That gets me my $2 because I received $865 and I paid $665. So you net that out, and that gets me $2 of a net credit. So technically my maximum risk is $8 because I've received $2. So I'm really trying to make $2 on this particular spread. If I'm going to hold it to expiry, I'm going to make $2 for the risk of $800, right? So I'm trying to make about 25% on this particular spread, and I put it on March 26 all the way to May. So let's say that's about 6 weeks, maybe a little bit more. So for 6 weeks of work, I'm trying to make 25% on this particular amount at risk. Now, why are we doing this? Well, if we could compare this, and I like to do straight up cash secured puts as well, given the right circumstances, perhaps the right kind of stock, my risk gauge is kind of giving the okay, because you're going to get a whole lot more premium. So imagine that we just sold this May 545 put. We're going to get $8.65 for it. That's a heck of a lot more than the $2, right? If I don't bother buying this lower put for $665, I get to keep the whole $865. So why wouldn't I do that every time? Well, we're going to get into some of the details as to really why in this particular case. But you can do that, right? You can just go and collect that $865, but you have to keep in mind that is, number one, you're going to take on a lot more risk. So you're selling this 545 for $865, which gives you a cushion of $865, but below 537.35, you are now going to be long Meta without any more cushion. So you're basically taking on the risk because you are obligated to buy stock at 545 by virtue of having sold this put. You are going to buy stock at 545. You got that 865 cushion. And now as the stock continues down, you're going to take part in the full down move in Meta beyond that. And because of that, there's another big difference. You're going to have to post the proper security for this trade, right? It's called a cash secured put because it is secured by cash that you should put aside for this particular trade. A lot of brokerages won't allow you to do it without that cash sitting there. So for this trade, if you were just going to sell a May 545 put, you're going to have to put aside $54,500 in cash to secure that trade. So that calculation comes from the strike price times 100 shares, which is going to be the amount of 54,500, because each 100 shares that you are obligated to buy per contract is going to cost you that amount. So very, very big difference from the credit vertical that is going to give you that $2 net credit, but only costs you $1,000, the difference between 545 and 535. So even though you're getting a significantly larger amount of premium from just doing the cash secured put, it is going to cost you a lot more capital that you need to set aside for this trade. So much, much less capital efficient when you do the calculation. So why wouldn't you just want to do these verticals all the time? Well, it depends the kind of trader you are. Sometimes people aren't going to just have that full amount of cash sitting there, and they're going to want to use that efficiency of using verticals, of doing vertical spreads more frequently. It's going to cost you a lot less to put those trades on. You can put more of them on. You can rinse and repeat for a lot less capital required. But sometimes, and for me, it's going to depend on the kind of environment that we're in. If we're in a very low volatility environment where, maybe the spread is only giving me $1.50 or not very much, I may defer to just doing a cash secured put in order to grab a little bit of extra premium in a market that's generally rather stable. But that is exactly one of the points of this video, is I want to show you the market that we were in when I put this trade on. And this is going to start to inform you as to maybe how you can adjust your strategy to conform to the various volatility environments that you're going to encounter over time. So let's take a look at that. Okay, so let's look at the broader market. So we're looking at the SPY here. SPY coming off of those nice highs that we saw post-election. Everybody getting very, very excited. Our MTI indicator started to get it's a very red, under 600 here, right? 597, I think it got bearish. So started to be very, very careful. Came down into here on a number of shows. I talked about how the gamma profile, the options were the VIX was sort of showing that we could probably get a very nice 150 to 200 point bounce, which we did. And we started to stabilize a little bit. And, I looked at basically the term structure at that point. This is back on March 26th. Pretty healthy, right? This is a good looking term structure. VIX maybe a little bit high, was probably down around here, but really kind of a nice look from a fear perspective in the VIX futures. If you look at our 9 data, the VIX, anything under 1 is starting to get a little bit worried, and I would say above 1.1 is a little bit treacherous, but we're kind of straddling between 1 and 110. So this is a signal that I get a little bit more worried about if we start to push above 110 very consistently. And sure enough, we got up there at some point as things got a little bit uglier. But generally speaking, I think, I sort of looked at this stock, came down, bounced up into here, which was this March 26 spot right here. And I said, they probably have a bit of a bottom set in here on Meta. At this point, stock I really, really love. So remember, number one rule is you have to really, really love the stocks that you're going to be selling cash secured puts on. Verticals, also very important, of course, more defined risk, but you really want to be involved in stocks that are of a higher quality in general, right? For the bulk of your sort of trading portfolio. So came down into here, and I said, it's worth a shot. We had Meta down from 740 down to 600, and I thought, this is probably not a bad shot. But I was, starting to see some worrisome signals, right? That VXST to VIX being a little bit more worried. Term structure pretty good, I would say overall. Another thing that's going to inform me is looking at option pricing on Meta, and we could see that on a short-term basis or shorter-term option basis, we start to see this implied volatility starting to rise in the name, as well as realized volatility. A lot of people focus on that implied. You really want to watch realized as well, because that's sort of the reality of the situation. Implied vols can kind of do a little bit of anything. Realized volatility is reality, right? That's what's happening. So it's starting to point straight up, and we get to March 26th, when I look at this trade, and we're starting to get that measure of volatility a little bit on the high side. And so if I bring in our IV percentile, IV rank, I've done videos on these, how you should measure them, how you should view them. And we can kind of see on March 26th that we're really getting those higher levels there, right? We can see 60th percentile IV rank at 45%. So really we're into the 50s now. And when we get up into the 50s on that blend that I like to look at, I start to get a little bit more worried. And that's where I start to move from preferring cash secured puts to verticals. Now, I've done other videos on this, but again, why do we want to have that, right? We want that extra protection. We're starting to get better implied vol, so we're going to get that nice little bit of extra premium there anyway. Certainly not as much as we would get just on a cash secured put, but we're starting to get a little bit more premium. But remember, it's for a reason. We have to observe what the market is telling us, and the market is telling us from a couple of different directions that this is a weak market. We have some very broken charts on the S&P, certainly on the Qs. And implied volatility is starting to reflect some real kind of worry out there. And we can see that in the percentiles and the rank. I don't like to use one or the other. A blend kind of works nicely just to give you an idea of, and I'll post that video that I made on IVP in the description there, so you can watch a little bit more of how I view that particular measure. So we're starting to get up there. So now I'm starting to say, well, you know what, not just a cash secured put, I'm much more favoring the vertical because anything can happen. Why else would I want that? Well, when you do the vertical, you're getting that long piece of gamma, right? You're buying that extra put. You're short the put, you're buying that extra put, which is obviously defining your risk to a very small amount, but it's giving you that little piece that you can play with when the markets get more volatile, if and when they get more volatile. And sure enough, let's watch and see what happens here. Okay, so what happens? We do our trade right in here, and then what happens? We get that follow through. They get absolutely smashed. The Meta gets hammered down to 560. It bounces up towards that 590, but basically in the S&P, we see the bottom falling out, the VIX starting to soar, and we see a real plunge down into the low 520s, 530s. So what happens on April 3rd, right here, I can see that I'm now underwater on the spread. But remember, I love Meta. I want to own Meta, but I also want to use that extra piece of protection that I have now. It's almost like my little soldier, my protective soldier, that I can move around the chessboard like a piece, right? So what I did was, I'll show you the trade in a minute. What I did was I rolled the 535 put, right? Because remember, I'm short the 545, I'm long the 535. I rolled that 535 put down to the 465. So let's take a quick look and see. Let's see what happens. So we're looking at the skew basically on Meta here, which is kind of showing us are puts more expensive than calls by how much. So we can see here on April 7, 8, 9, the skew absolutely exploded. That's what tends to happen in big sell-offs. Everyone's panicking, everybody's buying downside puts, and the skew blows out, meaning that those skew IVs just absolutely explode, those implied volatilities. That's usually a good sign that things have kind of overdone to the downside. So I could have waited a little bit longer. So on April 3rd, we had this little bit of a blowout before the big one. Could have waited a little bit longer, but Meta was actually kind of, outperforming to the downside, so to speak. Versus the market at that point. So I roll to the 465. Why am I doing that? Well, I want to take that protection that I basically paid. What did I pay for it? $665. I paid $665 for that 535 put. I rolled it out to the 465. So I sold it at 32.15 and I rolled it down to the 465 at 1050. So why wouldn't I just sell it out? Well, I wanted to maintain some protection, right? We're in the eye of the storm here. It's not quite time to remove your protection completely. This is where there's a little bit of art and science. You kind of have to be a little bit patient, and you have to be willing to kind of wait for a little bit of a coast is clear kind of signal. And so the coast wasn't quite clear, but I did want to monetize that put, and I rolled it down to the 465, which also keeps our capital a little bit more under control. So now we've turned it from a $10 spread into something more significant, right? We've turned it into an $80 spread. So now we're going to have to post the $8,000 instead of the $1,000 from the original spread. So we're posting a bit more capital, but we are starting to stick handle the situation and try to turn those lemons into lemonade, right? So we're still maintaining a reasonable amount of risk, right? We don't want to take it off completely and take on that full $53,000 worth of risk. But we are going to roll down. We're going to monetize those puts. We bought them at 665. We're selling them at 32.15. But we're going to go down. We're going to sell that 465 put in the same month for 10.50. So what happens to Meta here? Well, let's take a look. We've got Meta, basically, it starts to bounce around a little bit. It comes all the way back to 580. It was actually kind of spectacular. It sort of rallied at almost $100. And then came down again. So this is probably where I should have started to consider maybe taking off the short put, but vols were just so high, it was hard to do that. So I just kept the spread on. It came down and actually dipped very, very close to that bottom that we saw, but did not make a new low, or barely made a new low. So that was the signal to me that it was time to basically take this protection off, right? There comes a point where you're getting involved in a stock that you really love, that you want to be a part of, and you're going to take that little soldier and basically he's done his work and you're going to take that off and just keep that short put. So what that looks like is basically selling that 465, which I did for $20.35. So I rolled the original one, I paid 665, I sold it for 32.15, rolled it down to the next one for 10.50. So which I'm buying, right? I'm paying 10.50. Then I sold the one that I bought, the 465 that I bought for 10.50. And I sold it for $20.35. So made almost $10 on that one as well. So this is how you're kind of using that piece. We call that the long gamma piece, right? The short put is short gamma, that you're kind of just a passenger on that one, right? You're getting affected by the increase in implied volatility. You're getting affected by the market selling off. The long piece is benefiting from those very things that I'm talking about. An increase in the VIX from 20 to 40 is going to seep its way into the meta option. So you're playing the piece that's actually benefiting from a lot of this volatility, right? We want that when we have that somewhat more treacherous outlook, right? When I see those IVPs and IVRs nice and reasonably low, not too low, right? If you've taken my Vol Ninja series, you'll know that I don't like to take in every kind of low vol environment, but when we're in a reasonable range of volatility, then that's going to be your green light to basically be a little bit more aggressive on the option selling, right? I know some other places, Tasty, all these places say, no, keep your positions absolutely small until volatility explodes. I'm not so sure that's always the greatest thing. And in my view, having done it professionally for so long, I've preferred to kind of, be a little bit more careful in those very, very treacherous environments. And if you can get out ahead of some of those environments and sort of keep some dry powder, then you can take advantage of those VIX 40, 50, 60 environments because you've done the right thing and you've kind of gotten out. So in this case, we've got this vertical spread that's now helping us to try to lower our cost basis on Meta. So I'm going to show you the full math on this. And then what happens? Well, Meta comes all the way back and it comes into expiry. So on, not expiry, but rather right ahead of earnings, right? So into 430. And I didn't really want to hold these through earnings, right? This had been a bit of an adventure. And I figured, you know what, if I cover these, I'm going to buy back the short leg, right? Remember, I've been sitting on this short 545 the whole time. I haven't touched that leg of the trade. But it's coming back. I've sold it for $8.65 and I decide to cover it for $23.90. Why would I cover it for $23.90 when I sold it for $8.65? That's a pretty good loss on that short put. Well, I have turned the long put into a very, very nice couple of wins that is going to make up for this. And I'll show you the math at the end. We've turned this whole situation into a very nice trade. Now, sure, I wish I had kept it on because the earnings were terrific and the volatility collapsed and Meta rose, but I wasn't really in this trade to hold it through earnings, right? You have to kind of make these decisions. Holding those kinds of structures through earnings is sort of a negative edge type strategy. And really, over time, many studies have shown that it doesn't really pay to sell options into earnings. So it took it off, and plus I had an upside structure that was going to take care of this. So I will say that I have this upside broken wing butterfly that ended up being a killer. I just took off part of it for 143%. First part for 110%, next part for 143%. So I had that on and I figured I don't need to stay in this particular trade. So It bounced back, and into earnings, I just said, you know what, I've had enough of this. We've done really well. So let me talk about the math on this particular trade. Okay, so what's the bottom line after all of that? Okay, so we see the community trades here. So I put these out real time for people who are in the community doing fantastic. Here's somebody that did really well. And thanks again for your teaching on this one. Actually came out with a gain of $18.78. So he turned a $2 credit into an $18.78 credit by using this method to kind of keep rolling and keep monetizing given the various environments that you're in. Okay, so the original one, so we can look over here. The original one, we have our credits lined up, we have our debits lined up. We actually paid a little bit more for this one at the end, and it ended up being a profit of $20.05. So this is a $2 credit spread that ended up being a $20.05 credit in the end. So really a great outcome. Could have even been a lot better if I held through earnings, but that generally isn't my style. And I think you kind of have to have your rules. You got to have your way of doing things and kind of stick to them. If you're kind of all over the place, then you're going to get performance that's all over the place and really, you know, never kind of have sort of a system to kind of follow. So it doesn't mean you can't push a little bit outside those limits a little bit, but that's, you know, an earnings event is pretty unique, that carries a lot of gap risk. So, and also I had this upside fly, which again was in the community, bought these for $9.75, sold 2/3 of them at $20.50, and the last one at $24. So over 140% on the second one. So it's also a matter of, you know, I don't want to carry this through earnings, but I also have some other pokers in the fire, and, you know, of course, all kinds of other long things, long Goldman Sachs fly, and, you know, all kinds of other stuff. So, you know, sometimes you just have to look at the balance of your own particular portfolio. It's different for every member, different for every person. But hopefully that gives you a good idea of how to kind of turn those lemons into lemonade in a stock that you really like. Okay, so important to understand here that when you do take that bottom protective leg off, you are turning this into a much higher capital type trade, right? So you have to have that flexibility. Some people don't. They put on the trade because it's very capital efficient, and they need that efficiency to stay within the confines of the capital that they have to use, or the sort of approach that they're using. But I like this as a way to kind of push the boundaries of what you're doing in order to accomplish something perhaps more valuable, which is to you know, ultimately kind of accept the delivery of this stock, and having worked down that average cost over time, it ends up being kind of a trade that can work out well in the end. So it doesn't always work out perfectly like that, but really nice trade. And hopefully that gives you guys an idea of how a trade like that evolves, a case study in Meta looks. And hopefully you guys learned a little bit from that. If you have any questions, again, comments, and I have my mentoring program opening up soon. If it isn't, if you're watching this much later, there might be a list that you can get on at optionswithhans.com. You'll see mentoring at the top, but right now have the mentoring opening up. So reach out if you're interested. It's a 1-year program to turn you into a pro. So not from somebody who's done this, you know, for a few months or even a couple of years. This is somebody who's done this for a very long time, and we are going to go over every single nuance of what I have learned over 30 years of options market making, of being a derivatives arbitrage trader, volatility trader, options arbitrage, of running income funds, hundreds of millions of dollars in income funds. So really, it's going to be hard to find anything like that out there. Ivy League level training from an Ivy League guy who has done just about everything. So hopefully you guys enjoyed that, and we'll see you in the next video.